every single popular ETF you're being told to buy for 2025 is already obsolete. The S&P 500, VOO, a relic. The high-flying growth fund SCHG, a gamble dressed up as a strategy. For years they've been the gold standard, while a silent, more powerful vehicle has been hiding in plain sight, one that has quietly beaten them both, crushing the market with less risk. Its ticker is AOTG, and by the end of this video, you will understand exactly why this single ETF is the only one that matters for the next decade. This isn't a prediction, this is a pattern, and the data I'm about to show you is so compelling, it will change your entire approach to investing. Stay with me, because we're about to expose the one ETF that doesn't just follow the future, it's built to own it. The story begins with a simple idea, an idea that challenges everything people think they know about investing. For decades, new investors were told that winning in the stock market required picking the right companies, chasing the hottest trends, or trying to predict what the market would do next. But for one investor, the breakthrough came from doing the exact opposite. Instead of trying to beat the market, he learned how to let the market work for him through a strategy so simple that anyone could use it. The 3 ETF portfolio. This portfolio, at first glance, seems almost too simple. Just 3 ETFs, no complicated charts, no endless watch lists, no guessing games. And yet, this simple structure has helped regular people grow real wealth without stress, without excessive risk, and without needing to be glued to the market every day. This investor had spent years studying how wealth is really built, and he discovered that the right mix of only 3 ETFs could build a strong, diversified, and resilient portfolio. One that grows steadily, one that pays income, and one that benefits from the most powerful companies in the world. To understand why this 3 ETF strategy works so well, you have to look back at its origins. In the 1990s, investing pioneer Jack Bogle introduced the idea of the original 3-fund portfolio. It consisted of 3 simple components: U.S. stocks, international stocks, and U.S. bonds. It offered diversification, low fees, and simplicity, something that was revolutionary for its time. And, yes, it worked. If someone had invested just $500 a month for 25 years into that old 3-fund setup, they'd end up with over $420,000. Not bad at all. But markets evolve, technology evolves, the world changes. And today, investors have access to tools and ETFs that didn't exist back then. Funds that are more efficient, more diversified, and more reflective of the modern economy. When our investor updated that old system into a modern 3 ETF portfolio, the difference became shocking. That same $500 per month over the same 25-year period, over $1.1 million. That's more than double the return simply by adapting the strategy to today's financial world. But before diving into the ETFs themselves, it's important to explain what an ETF really is. Think of an ETF as a box of donuts. Inside the box, each donut represents a different stock. You're not buying individual donuts, you're buying the entire box. Instead of trying to pick which donut will taste the best, you simply enjoy the whole assortment. It's simple, diversified, and much easier than guessing which single donut or stock will outperform. The modern 3 ETF portfolio follows 3 basic principles. First, choose one ETF for each category. Don't overcomplicate it. This is meant to be simple. Second, know your investing personality. Are you a dividend investor, a growth investor, or do you want both? Steady income and strong long-term growth. And third, stay the course. Markets rise, markets fall, recessions come and go, but disciplined investors don't jump in and out based on fear. They hold, they invest regularly, and they let time do the heavy lifting. Now, let's break down the 3 categories of the modernized 3 ETF portfolio. The first category is the foundational ETF, the core of the portfolio. It must be safe, diversified, and powerful enough to build wealth over the long term. 2 of the best choices for this category are the S&P 500 ETF, or the total U.S. stock market ETF. The S&P 500 has returned over 10% annually since 1957 and includes the most powerful companies in the world: Apple, Microsoft, Tesla, Coca-Cola, and, honestly, hundreds more. It's a collection of companies that survived recessions, wars, crashes, pandemics, and still came out stronger. The total stock market ETF is similar, but includes smaller companies too, mid-caps and small caps, adding even more diversification. Either one works beautifully as the core. The second category is the Dividend ETF, the cash flow and stability portion of the portfolio. In the old three-fund system, this category was filled by bonds. Back then it made sense. Bonds were stable, they paid interest, and they were considered a safe hedge. But times have changed. Over the past decade, bonds returned almost nothing, around 1.5%. Inflation ate up more than that, making bonds a losing bet. Dividend ETFs became the modern replacement. They provide steady cash flow, strong companies, lower volatility than growth stocks, and the magic of rising dividends. Mature companies with reliable revenue pay investors consistent dividends as a reward for holding the stock. These dividends grow year after year, creating a snowball effect that becomes more powerful over time. This investor chose 2 dividend ETFs for his accounts, one for his Roth IRA and one for his taxable brokerage account. Because each account had different goals, these funds provided both capital appreciation and dependable dividend income, often yielding between 2 and 3%. Over the long term, these payments grow large enough to cover real expenses, mortgages, car payments, vacations, or even early retirement. So, let's look at a simple comparison that really shows just how powerful dividend ETFs can be. If you invested $50,000 into a total bond market ETF, after 10 years, it might grow to about $58,000. Yeah, barely anything. But if you put that same $50,000 into a high-quality dividend ETF, well, after 10 years, you could be looking at nearly $150,000, plus thousands of dollars in dividend income along the way. Now, the third category is the growth ETF. In the old-school three-fund portfolio, this spot was usually filled with international stocks, but these days, the world's largest US companies already do business all over the globe, which makes international funds a lot less impactful than they used to be. That's why the modern approach swaps out international exposure for technology-heavy, growth-focused ETFs instead. Growth ETFs are all about innovative companies. Think software, semiconductors, cloud computing, artificial intelligence, all those businesses that are expanding fast, bringing in more revenue every year, and really driving the future of the global economy. These ETFs often outperform the overall market since they're packed with companies that are literally changing the world. Some of the strongest growth ETFs out there today have actually returned around 15% per year, which is way higher than the S&P 500. The investor in this story picked 2 different growth ETFs for separate accounts, so he could capture both aggressive growth and solid long-term performance. So, when you combine these 3 categories, foundation, dividends, and growth, the modern 3 ETF portfolio becomes honestly incredibly powerful. When the investor backtested his modern portfolio against the old 1990s version, there was really no comparison. The new portfolio produced dramatically higher annual returns, more growth, more diversification, and, well, significantly more wealth. He even tested it against just investing in the S&P 500 alone, and once again, the 3 ETF mix won. Eventually, the investor built 3 ETF portfolios across 2 different accounts. His Roth IRA was all about maximum long-term growth, holding a foundational ETF, a growth ETF, and a dividend ETF, with a heavier allocation toward the growth side. Meanwhile, his taxable brokerage account focused on balancing growth and income, pairing the S&P 500 ETF with a dividend ETF and a growth ETF, with the largest allocation going to the S&P 500, just because of its long-term reliability. The key to both portfolios was, honestly, consistency. Dollar-cost averaging, buying regularly no matter what the market was doing, allowed him to keep accumulating shares at really great prices. He didn't worry about daily movements. He didn't panic during pullbacks. He simply invested, held, and trusted the strategy. Over time, the results spoke for themselves: high returns, steady income, and a portfolio that grew larger every single year. This is the power of the modern 3 ETF portfolio. Simple, diversified, proven, a strategy built not on guessing but on discipline, not on luck but on patience, and not on stressful day trading but on long-term wealth building. Anyone can follow it, anyone can start, and with consistency and time, anyone can become wealthy through this exact system. Now that you understand the foundation of the modern 3 ETF portfolio and why it vastly outperforms the old version, let's move deeper into how this strategy actually works over decades, why these ETFs behave the way they do, how to structure a portfolio based on your personal goals, and the truth about long-term discipline that separates wealthy investors from everyone else. Because at the end of the day, a 3 ETF portfolio is not just about clicking buy 3 times and walking away. It's about understanding why these 3 categories work, how they balance each other, and what role they play in the long-term compounding machine that quietly builds wealth in the background of your life. Why the new 3 ETF portfolio dominates the old traditional version. Let's begin by revisiting a crucial point that most beginner investors overlook. The old 3 fund strategy was designed for a world that no longer exists. Back in the 1990s, international exposure made perfect sense. US companies weren't operating globally at the level they are today. Back then, supply chains were more local, communication technology wasn't nearly as advanced, and international markets served a purpose that US companies just couldn't replicate. But today, well, Apple sells iPhones in nearly every developed nation. Microsoft powers businesses in every corner of the world. Tesla sells cars in Europe, China, and North America. Nvidia supplies chips globally. And Coca-Cola, honestly, it practically has more distribution than clean running water. US companies are global companies now. This is the primary reason why the international slice of the old 3 ETF strategy simply doesn't produce the same returns anymore. While international funds have lagged at 3 to 5% annual returns, US large-cap growth and dividend ETFs have repeatedly produced 10 to 15% per year. Same number of funds, better allocation, far better outcome. That's why the updated 3 ETF portfolio is not just a modern preference. It's an entirely different system built for the reality of today's globalized economy. Breaking down each category with more depth. First, the foundational ETF, the engine of the portfolio. Your foundational ETF is your long-term wealth generator. It's the ETF that you buy the most consistently, holds the most reliable companies, has the longest track record, and acts as the stabilizer for the entire strategy. This is why VOO and VTI remain the top choices. VOO tracks the S&P 500, the 500 largest US companies. VTI tracks the entire US stock market, thousands of companies. Historically, VOO averages about 10% annually, and VTI averages slightly above that at around 10.5%, but in both cases, you are investing in the heartbeat of the US economy. This ETF category is your long-term workhorse. If you stopped investing in everything else and only held VOO or VTI for over 30 years, you would already outperform 90% of all investors, including many professionals. The foundational ETF is the most boring, yet most effective part of the portfolio.